Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at MP Materials.
If you find our talks useful, please consider subscribe, like, and comment underneath. Now, for today's deep dive, we are looking at a company that is essentially tearing up its own highly profitable floorboards, just to build an entirely new foundation.
Yeah, it's a pretty radical shift.
Right. I mean, picture this. You're examining a company that's in the middle of this unprecedented real-time business model transformation. They aren't just tweaking operations or launching some side product.
No, they're attempting a massive pivot.
Exactly. MP Materials is shifting from a traditional mining outfit, literally just pulling rocks out of the ground and selling raw powder, into a fully vertically integrated mine-to-magnet manufacturer. So we're going to unpack exactly what this means for you if you're watching this space and looking at the long-term industrial landscape.
It is, frankly, a fascinating evolution to watch, and it's really important to understand the sheer scale of what you're witnessing here.
It's massive, right?
Oh, absolutely. We're talking about fundamentally altering how critical supply chains operate in the Western Hemisphere. Like, turning raw earth into a highly engineered permanent magnet is not just a simple step up, it's an entirely different universe of chemical engineering and metallurgy.
Well, let's get right into the financial reality of a transition like that, because gutting your entire business model is incredibly expensive.
Beyond expensive, yeah.
But if you look at their recent filings, the top-line growth is actually already showing up. In fiscal year 2025, their revenue hit just over $275 million.
Which is a 35% year-over-year increase.
Right. And that kind of jump usually suggests a company is just firing on all cylinders.
It does, and that revenue growth is actually being driven by tangible physical output, not just, favorable pricing in the commodities market. They achieved record production at their Mountain Pass facility.
How much are we talking?
We're looking at just over 50,000 metric tons of rare earth oxide produced in fiscal 2025. But the real standout is their production of NdPr oxide, which roughly doubled to about 2,600 metric tons.
Okay, wait. For those listening who might not be material scientists, what exactly is NdPr? And why does doubling it matter so much?
So NdPr stands for neodymium and praseodymium. They're two specific rare earth elements that, when you combine and refine them, they act as the magic ingredient for high-performance permanent magnets.
So these are the magnets going into electric vehicles and stuff.
Exactly. EV motors, wind turbines, robotics, advanced drones. Essentially, if you want to turn electricity into motion with really high efficiency, you need NdPr.
Got it.
So doubling that specific output means MP Materials is successfully isolating the most lucrative, strategically vital part of the ore they pull from the ground.
But here is where the story gets really contradictory, and frankly, a bit confusing if you're just glancing at their headline numbers.
The margin?
Yes, the margins. You have this record production, a 35% revenue jump, double the NdPr. Yet, for fiscal 2025, they posted a net loss of almost $86 million.
Yeah, that catches a lot of people off guard.
And the current gross margins. They're sitting at nearly negative 280%. How does a company with those kind of production wins hemorrhage that much money on a gross margin basis?
I mean, a negative 280% gross margin is a staggering figure to see on any balance sheet, but the context here is literally everything.
Okay, break that down for us.
That deeply negative number is entirely due to the heavy, capital-intensive scaling and pre-production costs for their downstream magnetics facilities. The process of taking refined NdPr and turning it into a finished magnet involves complex alloy casting, milling, pressing, sintering at extreme temperatures. It's a lot.
So it's heavily front-loaded.
Exactly.
Yeah.
Building out those advanced assembly lines requires hundreds of millions of dollars upfront before a single finished magnet is ever sold.
It's like owning a massive, highly profitable factory and deciding to do a complete floor-to-ceiling gut renovation while you are still trying to operate out the front door.
That's a perfect way to put it.
You're buying brand new state-of-the-art assembly lines, pouring concrete, paying specialized engineers, which just temporarily destroys your current margins.
Right, but you endure the pain now because the future operational leverage is the whole point. Selling a finished, highly engineered product instead of a bag of raw powder is where the real money is.
And if you look past the annual net loss and zoom in on the momentum, the trajectory inflected sharply in the second half of the year, didn't it?
It really did. In the fourth quarter of 2025, they generated nearly $39 million in adjusted EBITDA.
Just to clarify for you listening, when we say adjusted EBITDA, we're talking about their core cash profit from operations before all the accounting noise. Things like interest, taxes, depreciation.
Right. It's a cleaner way to see if the core business engine is actually making money.
And that $39 million was their first profitable quarter on that specific metric, right?
It was. And not just barely profitable. That represented a 466% year-over-year increase for that quarter. It signals that the underlying mining and refining engine is beginning to generate serious cash.
Even while the broader, expensive factory renovation is ongoing. But wait, if I'm gutting my house, I'm burning cash fast. How is MP Materials surviving negative 280% margins on the manufacturing side without just diluting their shareholders to zero?
Well, they've constructed what can only be described as a fortress balance sheet.
Really? How much cash do they have?
At the end of 2025, they were sitting on over $1.8 billion in cash.
A $1.8 billion war chest. Okay, that is a completely different conversation. Where does a company transitioning out of traditional mining get that kind of capital?
From some of the heaviest hitters on the planet, honestly. Entities who view this company not just as a stock, but as a strategic necessity. For starters, they secured a $400 million convertible preferred equity investment from the Department of Defense.
Wait, the U.S. military is taking a direct financial stake. I get government grants, but preferred equity means the Pentagon essentially owns a piece of the company.
Yes, it represents approximately 15% of the company through preferred equity and warrants.
That's wild.
It is. A convertible preferred equity structure means the government gets a safer position than regular stock owners in a worst-case scenario. But it provides MP Materials with an immediate, massive cash injection without having to go to a traditional bank with crazy high interest rates.
And it doesn't stop with the military, does it?
No, not at all. They also received a $32 million progress payment directly from Apple and a $50 million prepayment from General Motors.
I always pay attention when companies receive prepayments. When Apple and General Motors are writing you 8-figure checks before the factory is even finished, that's the ultimate signal of high conviction.
Or desperation.
Yeah, exactly. They're essentially saying, we need a secure supply of these magnets so badly, we will fund your build-out ourselves. Let me challenge this a bit.
Sure, go for it.
If the EV and consumer electronics markets are so lucrative that the DoD, Apple, and GM are willing to write blank checks, why is MP Materials getting all this capital? Surely there are other mining companies trying to spin up operations, right?
Trying is the operative word there. They're receiving this capital because of their moat, which is arguably one of the most impenetrable in the industrial sector right now.
What makes it so impenetrable?
MP operates Mountain Pass in California. It is the only active, fully scaled rare earth mine and processing facility in the entire United States. It represents about 11.5% of total global output.
Okay, but what about the rest of the world? Are we really relying on one facility in California?
Pretty much. Outside of China, there are effectively only 2 scaled producers of NdPr oxide on the planet. One is MP Materials. The other is Lynas, a major Western competitor operating in Australia and Malaysia.
And what about Lynas?
Well, Lynas has largely committed its output to Japan to feed their auto industry. That leaves MP Materials as the sole scalable supplier for the entire United States industrial base.
The sole scalable supplier for the entire country. That is a massive amount of leverage.
Exactly, and they've actively weaponized that leverage. They structurally decoupled from China by mandating a cessation of their concentrate sales to Shanghai Resources, which used to process their raw materials.
So they completely cut off the Chinese offtake.
Yep. By doing that, MP transformed itself into an irreplaceable, standalone domestic asset. You can't just find a new deposit, get the decades of environmental permitting required to process radioactive byproducts, and spin up a rare earth mine in the U.S. overnight.
The barriers to entry are just insurmountable.
For at least the next decade, absolutely.
All right, I'm going to play devil's advocate here. They have a geographic monopoly, they're backed by the Pentagon, and Apple and GM are pre-funding them. It sounds like a guaranteed win. So why are there skeptics? What's the bear case?
The catch is the sheer engineering complexity and the staggering cost of what they're trying to achieve next. Their capital expenditure guidance for fiscal year 2026 is an estimated $500 to $600 million.
$500 million in 1 year just on capital expenditures. That sounds like a recipe for a blown budget.
It's a monumental spend. that covers the build-out of their so-called 10X magnetics facility in Texas, the expansion of their Independence operations, and the heavy rare earth separations and recycling infrastructure.
So the execution risk here is immense.
Immense. We are talking about precision manufacturing at scale. There is zero margin for delay on these complex capital projects if they're going to meet the Department of Defense offtake timeline.
Right. Any cost overruns, any engineering bottlenecks, and that cash burn could accelerate alarmingly.
Precisely. And that brings us to the valuation, which, if you look at traditional metrics, is priced for absolute perfection.
Yeah, let's talk numbers. Currently, MP trades at a forward 12-month price-to-sales multiple of around 20.48. Just for context, the industry average for materials companies is about 1.4.
It's a huge premium.
And their forward earnings multiple is roughly 1,430. If they stumble even slightly on building out that 10X facility in Texas, a valuation that steep could plummet. Why would anyone pay over 20 times sales for a company taking on that much execution risk?
That is the textbook bear argument. And if this were a standard mining company, a 20 times price to sales multiple would be terrifying.
But it's not standard.
Right. The critical mitigation factor that justifies that structural premium is the Department of Defense partnership we discussed earlier. It is not just an equity investment. That agreement includes a sovereign guaranteed price floor tied to NdPr pricing for their upstream and midstream operations.
Okay, explain how a sovereign price floor actually functions in practice, because commodity markets are notoriously volatile. If the price of rare earths crashes tomorrow, what happens?
So if the global spot price of NdPr drops below a certain threshold, say, if China decides to flood the market with cheap materials to bankrupt Western competitors, the U.S. government effectively covers the gap.
Oh, wow. So it fundamentally de-risks the downside.
Completely. The government ensures MPP Materials still receives a set minimum price for their output. This guarantees a baseline of profitability regardless of geopolitical dumping or spot commodity volatility.
So the Pentagon is essentially acting as a financial backstop against market manipulation.
Precisely. And that price floor is the mechanism that drove that massive jump in fourth quarter adjusted EBITDA. Management has guided that once the DoD agreement elements are fully realized, they have a targeted minimum EBITDA of roughly $650 million.
$650 million minimum.
Yep, with over $400 million of that coming from the materials segment alone.
That completely changes the math. A $1.8 billion cash buffer gives them the runway to physically build the factories, and the DoD price floor puts an absolute safety net underneath their future revenue.
Exactly.
So what we have is this intense tug of war. On one side, you have near-term skeptics pointing to a sky-high valuation and massive execution risks. On the other side, you have long-term believers looking at an impenetrable moat backed by the U.S. military. As a result, the stock chart is telling an incredibly volatile, fascinating story.
It's a textbook example of market psychology playing out in price action. Over the past year, the stock surged roughly 138%.
Huge run.
But recently, it pulled back from all-time highs near $100 to trade around $62.
For those listening who track the charts to understand market sentiment, it's currently in what technical analysts call a high base formation.
Which is really interesting to see here.
Yeah, and for anyone unfamiliar with the jargon, a high base formation is essentially when a stock goes on a massive run, but instead of crashing back down as early investors take profits, it just moves sideways. It consolidates near the top.
It's like a climber catching their breath halfway up a mountain before the next ascent.
Exactly. It's a consolidating along the 50, 100, and 200-day moving averages.
And that ongoing consolidation signals robust institutional support. The fact that it is holding its ground and digesting those prior gains suggests it's building a sturdy launchpad. Wall Street seems to agree too.
Yeah, the analyst note's been pretty solid.
You have public sentiment like Jim Cramer recently noting that a $10 billion valuation for this company doesn't make sense to him, strongly implying the strategic value should be priced much higher.
And you have Jefferies analysts maintaining their optimism as well.
Right. They acknowledge there might be near-term demand risks in consumer electronics, but the overarching long-term demand for electrification and drone applications provides a rock-solid foundation.
But I want to highlight a specific, explosive dynamic in the market data. The momentum clearly shows long-term institutional accumulation. Apple, GM, the DoD, the diamond-handed players are in for the long haul.
Sure.
However, there is currently an elevated short interest ratio. There are a lot of hedge funds and near-term skeptics betting heavily against this premium valuation. What happens when you have an unstoppable force of institutional buying meeting an immovable object of short sellers? Doesn't this create the exact recipe for a short squeeze?
Oh, it's an absolute powder keg. Let's walk through the mechanics of a short squeeze real quick.
Yeah.
Short sellers borrow shares and sell them, betting the price will fall so they can buy them back cheaper.
Right.
But when you have a stock holding strong technical support, any unexpected positive news acts as a spark. If MP reports early magnet revenue or faster than expected project timelines, the stock price ticks up.
And those short sellers start losing money fast.
Exactly. To stop the bleeding, they're forced to buy shares to cover their positions,
And that forced buying pushes the price even higher.
which forces even more short sellers to buy back in. It becomes a self-fulfilling, violent upward cycle. The fresh attention drawn to the stock as it spikes confirms the growing institutional interest, leaving the skeptics completely trapped.
So what could be the spark that lights this powder keg? Let's look at the catalyst calendar for the next 3 months. First up, we have Q1 2026 earnings, expected in late April or early May. What are we looking for there?
That earnings call will be heavily scrutinized for the exact financial impact of the new DoD price floor. Analysts will want to see the math actually in action.
And they'll probably want updates on the construction.
Oh, definitely. They'll be demanding firm timeline confirmations for the Independence expansion and that Texas 10X facility. Any positive surprise there, any indication that they are ahead of schedule or under budget, could easily be the catalyst that forces shorts to cover.
Then from an operational standpoint, they have a planned shutdown in April at the Mountain Pass facility for preventative maintenance and what they call debottlenecking. Now, sometimes the broader market hears the word shutdown and panics, but debottlenecking is actually a positive, right?
Very much so. Debottlenecking is the process of finding the specific point in an assembly line that slows everything else down and upgrading it.
So it's a structural fix.
Right. It requires pausing operations, which means short-term pain in terms of output. But this specific April shutdown is expected to unlock meaningful, permanent growth in their output capacity for the second half of 2026.
That makes sense.
Beyond that, the highly anticipated official groundbreaking ceremony for the 10X facility in Texas will serve as a major, tangible milestone. Seeing shovels in the ground proves to the market that the transition is real.
And we cannot ignore the broader macro environment. We are seeing intense, ongoing U.S.-China trade friction. China has already implemented retaliatory tariffs and export controls on certain rare earths.
Yeah, that decoupling is accelerating.
It's not just political posturing anymore. It's forcing urgent inquiries from massive manufacturers who suddenly realize they desperately need a secure, non-Chinese supply chain today, not 5 years from now. It is rapidly accelerating the strategic reshoring narrative that MP Materials is entirely built upon. Just to be clear, we're not taking a political stance on trade wars here, but strictly looking at the market reality. This friction directly benefits MP.
Absolutely. There's even speculative chatter in the policy world right now. With the U.S. government taking such an active financial stake in a domestic critical mineral company, we could see further government action.
Like what?
We might see things like additional tariffs on Chinese-made magnets, or targeted tax incentives for automakers who use domestic magnets, or even an expansion of the DoD offtake agreement.
Any single one of those policy shifts would rapidly accelerate MP's revenue timeline and validate their valuation premium overnight. Let's pull all of this together into a cohesive summary. For you listening, weighing this information, here is the distillation of the thesis. You are looking at a company that earns a bullish score of 8 out of 10 based on the underlying fundamentals and strategic positioning.
Strong setup.
They are the sole Western owner-operator of a scaled rare earth supply chain. They're insulated by a $1.8 billion cash buffer, and their near-term downstream capacity is completely pre-sold to the U.S. military, Apple, and General Motors.
The crucial takeaway regarding the investment horizon, though, is patience. This is not a quick day trade to play earnings volatility.
Right, it's a long game.
This thesis is built on a multi-year timeline, targeting a 2 to 3 year hold to fully capture the 2028 commissioning of that 10X facility. That is when the realization of that massive $650 million guaranteed EBITDA floor comes to fruition. It offers a very compelling risk-to-reward setup if you're looking to gain exposure to a structural, multi-decade industrial shift.
It really is a remarkable story of industrial reshoring and corporate transformation, which leaves us with a final provocative thought for you to ponder. MP Materials is currently building out its capacity based on a 2028 timeline.
Right.
But if the United States government and these massive megacorporations are already heavily subsidizing this single domestic choke point today, what happens to MP Materials' pricing power if geopolitical decoupling accelerates and global supply chains fracture even faster than anyone anticipates?
It is a profound question about leverage. If the tap is turned off globally, possessing the only domestic well becomes invaluable.
Definitely something to think about. Thank you for joining today's deep dive into the underlying forces shaping the market. Remember to stay informed, keep doing your research, and always look beneath the surface of the headlines. We will see you next time.